Welcome back to the channel, folks. This is Jason, host of Fighting Words Financial, and this is part 2 of the 10 most common investing mistakes and how to avoid them. All right, guys, like I said, part 2 of my top 10 list of most common investing mistakes, but in no particular order. And this is for folks who are self-invested directors. Once again, I am assuming that you are already smart enough not to fall for the biggest mistake of all, which is paying excessive fees and commissions by working usually with the wrong advisor. Either do it yourself or find an advisor with reasonable fees. So let's go. If you recall from part 1 of this video, the last mistake that I mentioned was focusing too much on avoiding taxes, and I mentioned that it can have a cascading effect. The next 2 mistakes are something that I realize that I am in danger of because I am absolutely guilty of the mistake number 6 from the previous video, which is focusing too much on avoiding taxes, and it has directly led to the next 2 mistakes. So let's jump right into that list. So number 5, taking too much risk or too little risk. In my case, I'm taking too much risk. But you can't avoid risk altogether. So investing involves some level of taking risk in exchange for potential reward. It isn't a one-to-one exchange, though, meaning that for every given unit of risk that you take, that you receive an equivalent unit of return. That's not how it works. In my case, my desire to avoid paying capital gains tax has led me to take an undue amount of risk. I have a high concentration in my personal portfolio in a single stock. It's a high enough concentration that it violates my own personal written policy statement, my own investment policy statement. In that document that I hand wrote, I said in there that I would not allow any asset in my portfolio to ever exceed more than 10% of my overall net worth. Tesla has exceeded that threshold now for over 2 years, and I haven't done anything about it. But I'm going to. I promise you guys. By the end of the month, I'm going to sell at least a single share and reinvest those proceeds elsewhere. I promise you I'm going to do that by the end of the month. But let's talk a little bit more generally. Taking too much risk by having a high concentration of your wealth in a single investment can lead to large variations in investment performance that may be well outside your comfort zone and may cause undue amounts of anxiety and stress. Taking too little risk on the other end of the spectrum can result in returns that are too low to achieve your investment goals. Also from video number 1, make sure that you know your financial and emotional ability to take risks and recognize the investment risks that you are taking. You can avoid taking too much or too little risk by learning about some of the things that I find very interesting, but most other people find really boring. I am talking about ways to quantify risk. I am talking about these exciting things: alpha, beta, standard deviation, R-squared, and Sharpe ratio. I've almost never met one of these little investment tricks to quantify risk that I didn't like. I've really exciting stuff for nerds like me. Also learn about capital asset pricing models and something called value at risk in order to measure the risk to reward trade-off with assets and portfolios. Number 4, failing to diversify enough. Yet again, I have a personal example how one mistake that I am guilty of, tax avoidance, can lead to other mistakes in a cascading effect. Because I love Tesla and I really hate taxes, and really I love electric vehicles in general, I have uncomfortable concentrations of my personal net worth in a single highly volatile asset, and some of the other assets that I own are really highly correlated to Tesla. It's potentially a really big mistake that is causing me to take too much risk, and it could mean that I'm not sufficiently diversified, although I have made a concerted effort to invest not only in individual stocks for a large part of my portfolio, but the vast majority of my portfolio is actually a broadly based ETF allocation. The only way to ensure that I'm able to meet my investment objectives is to create a portfolio with enough diversification that it has the potential to provide appropriate levels of risk and return in various market scenarios and conditions. Often investors think that they can maximize returns by taking the largest amount of exposure in one particular security or sector, and that has certainly worked for a few people, but that's how most people actually lose their money too. That is not how I ended up with so much Tesla stock, folks, though. I bought my first 100 shares for like $3,300. It's just grown astronomically. But when the market moves against a concentrated position like Tesla, like it has several times in the past, it can be a wild ride. I think that if Tesla is really going to split again sometime soon, I'm going to be forced to make some decisions about when it's time to sell some of the shares that I have and reallocate in order to diversify my overall portfolio and reduce the amount of risk that I'm taking. On the other end, though, too much diversification, too much exposures can really affect performance as well. The best course of action is to find a happy medium. And that's actually one of the ways that a financial advisor can really provide value. Most of the serious ones have access to some really sophisticated tools that can help you quantify risk. I'm talking about tools like Morningstar, Black Diamond, Hidden Levers. They can help you find some of the hidden risks that you might not be aware that are there and help you to moderate and diversify your portfolio. It can be worth it to seek out the advice of a professional advisor on a flat fee or hourly basis. You can avoid this mistake of not being sufficiently diversified by signing up for a service like Morningstar on your own and finding out how diversified or how correlated your portfolio is. You are likely to find out that you are far less diversified than you think. And I say this because after 2 decades as a financial advisor, this is one of the things I most commonly find. Number 3, trading too much. Frequent trading is a return killer. We established in part 1 of this video that market timing is futile, right? You did Google the phrase best 10 days of the market, right? So we established that you don't have any special market timing talents and no superpowers of clairvoyance. I hope we're all on the same page here. Short-term tax rates can eat you alive if you are a frequent trader, but let's face it, the vast majority of day traders actually go broke. And then there's the incalculable, in many cases, opportunity cost of missing out on long-term gains of a sensible investment strategy. The next statement is backed by reams and reams of research as well. Most investors who make money by investing make money by doing nothing, meaning they do their due diligence up front. They choose investments with good long-term prospects, and then they are patient and they wait. They don't react strongly to media. There are probably a dozen 24-hour financial news channels, not to mention YouTube channels, that make money by showing actionable information. And trust me, all of the major trading houses advertise on these channels because they make money when you trade, not when you buy and hold. But there's so much information out there anyway, it would be ludicrous to try and keep up with all the so-called actionable information. The key to avoiding this mistake is being able to parse all of the valuable information out of the fake news and the hype. Successful and seasoned investors gather information from several independent sources and conduct their own research and analysis. No one else's opinion of an investment should be sufficient to convince you to plop down your hard-earned cash. Using the news or a YouTube channel as your sole source of investment information or analysis is a common investor mistake, a fatal mistake in many cases, because by the time the information goes public, it's already been factored into market pricing. This is one of the many reasons why frequent trading is a return killer. The other thing to remember as well, that most people, when they make a trade, they make a mistake. And when I say most people, think of it this way. On either end of a transaction, there's almost always a winner and a loser in that transaction, meaning somebody is benefiting and somebody's missing out on an opportunity. The more times you trade, the more frequent your chances are that you are going to be the loser in that transaction. All right, on to number 2, mental accounting. Now, this is a little bit harder to understand. It's an emotional reaction to numbers that you don't like, meaning staring at red on a screen and then you make some sort of logical flaw in your thinking and make a decision based on those numbers that doesn't make a lot of sense. Basically, the math only looks logical on a subjective basis to you. And I say that tongue in cheek, but it can have a real cost. One of the best examples of mental accounting is waiting to get even on an investment that you've lost money on. Let's say you lost a bunch of money in a stock and you're waiting to sell that loser until it gets back to cost basis. You just don't want to sell at a loss. So let's eliminate a few things here. Is there a decline in the macroeconomic situation, something that isn't company specific, that's more generally driving stock prices down for the entire stock market, or maybe it's just that sector? Is there a fundamental change in the company fundamentals that prompted you to buy the stock to begin with? Well, in that case, you may want to reevaluate. Wait, did you buy that stock on its fundamentals? Because a lot of people don't. Should you really reevaluate why you purchased the stock to begin with? And perhaps there's no fundamental reason to own it at all at this point. You're just waiting to get back to even. Waiting to sell a loser until it gets back to its original cost is often why overall portfolio returns get dragged down over time. And people tend to mentally remove that particular stock that you're down on from your overall portfolio and say, oh, the rest of my portfolio is doing just fine. This is called something in behavioral finance, we call it a cognitive bias or a cognitive failing, right? By failing to bite the bullet and take the loss, investors are actually losing money in two ways. First, they avoid selling a loser, which may continue to slide in price until it's worthless. Been there, done that. Second, there's the opportunity cost. You're probably missing out on a better use of those investment dollars. You can avoid this by learning to quantify and evaluate the fundamental reasons to buy, hold, and dispose of a security. Number one, and this is the only one that's actually in order, the number one mistake that most people commit while they're investing is letting their emotions rule. By far, the number one killer of investment returns is your emotions. Fear and greed rule the market, but they don't have to rule you. Investors should not let fear or greed control their decisions. Instead, they should focus on that bigger long-term picture. Stock market returns may deviate wildly over a shorter time frame, up 50% one year, down 50% the next. But over the long term, historical returns for large cap stocks generally average around 10%. It really is unrealistic to expect returns greater than that over time. Over a long time horizon, a portfolio's returns really shouldn't deviate very much from those averages for the particular asset class that it belongs to, unless there's a lot of luck involved. In fact, this is kind of the whole thesis behind index investing. Index investing is only successful for patient investors because an efficient market exists. And an efficient market exists only because of the millions of impatient investors making irrational decisions that cancel each other out. Patient, rational investors who do not let emotions rule them benefit directly from the irrational decisions of other investors, whether they invest in individual stocks or index funds. Avoid this mistake by learning to recognize your own emotional state. Besides all of the people that I encounter who believe they have magical market timing powers, this is probably the most powerful and most difficult mistake to correct. According to scientific research, most people actually make money decisions on an emotional basis and not a rational one. This blew me away when I first learned it. It seemed absurd. But as I became a financial advisor for a regional bank and then a much larger institution, I can tell you that we received very little technical training in finance, but we did receive a lot of training on how to recognize the emotional state of potential customers and how to get them to make decisions based on those emotions. Not very honest in my opinion. Now, I don't know a way to easily fix this problem. We seem hardwired to make decisions about money in this manner. So learn as much as you can about this subject and how your own emotional state or emotional attachments can affect your decision-making process. Well, there you have it, folks. The top 10 investing mistakes in no particular order except number one, don't let your emotions rule you. This is definitely the most important one. I hope you refer back to this video occasionally to see if you're making any of these mistakes. I'll be taking action on my own portfolio at least by the end of the month as a result of making these videos. Let me know in the comments if you think that I left anything out. Like and subscribe and hit the bell for notifications. Also, check out my Patreon link in the description. I'd love to see you guys in our private chat. I'll see you next time, folks. Have a nice day.